today's event. We had a great luncheon event where June talked about her background, how she got into the hedge fund business, and how she's looking at China. And tonight she wanted to go into a little more detail about how she makes some of her calls on some of the companies in China, her on-the-ground research, and some of the issues with investing in China. I think it's a great discussion. JunhLi runs JL Warren Capital, Chinese-focused equity research firm based in New York. She's also the author of Tiger Woman on Wall Street, Winning Strategies from Shanghai to New York and Back Again. Everyone who's read the book tells me it's tremendous. I've only skimmed it, but it's a great story of her life and also a great story about investing and fundamental investing based on research and an edge. And I think that we are all looking for that edge, and I think that how she gets it and how she does it with China will be an interesting topic tonight. Jean's work appeared in Forbes, Bloomberg, the Wall Street Journal. There's an interesting video clip from her on CNBC where she's the China bear and someone else is the China bull. I think all of this is very relevant today with the renminbi devaluation and what's happening. And I think it couldn't come at a better time for us to try to figure out what's going to happen with China if it goes into a recession and how does it affect us. So I'm really looking forward to the topic tonight. June received her MBA from Columbia Business School and her BA in economics from Middlebury College. I think that you're going to enjoy it, and hopefully we have a good night. Now, please bring a warm Atlanta Society welcome for JunhLi.
Thank you, Steve. Can you guys hear me well? Yes. Thank you for coming, especially those who already came at lunch. I hope it's not the food. So I have a mandate here, 30 minutes, and I need to discuss China kind of in a pretty broad term, and I think it's a pretty challenging task. So I think I think it's a good storyline if I can just sort of discuss my view and our work on China by sort of our daily work, research, analysis, and observations. I run JL Warren Capital. We are an independent equity research firm. And when it comes to China, it's inevitable that we also print ourselves and stay on top of macro and policies, because by large, it's still a command-based economy. Policies and the regulations play a very important role as to how people behave and how business run, how market reacts. We do Chinese equities, but not just the Chinese companies, but also everything that's broadly exposed to China. So in a sense, a lot of multinationals such as BMW, such as Tesla, Young Brands, Swatch Group, Richmond are under our coverage. The reason that I got involved with China was when I was a hedge fund analyst at a spin-off from SAC Capital. I saw the surge of China-based companies listed in the US. And I recognized that most of them are typically poorly covered, and the delta information and analysis are very attractive. And I am a strong believer in people should not invest in anything, in any stock, investment instrument, until they are convinced that they have a very attractive conviction in their view versus the consensus. So we are stock analysts, we are not company analysts. Companies are driven by the underlying business, but the stocks are driven by the difference between consensus and the reality. So we focus on that. Right now, this year, I chose 5 strategic sectors to help our clients to attract China and make money long or short on China-related stocks. Real estate, which I think is the linchpin of the Chinese economy because it drives construction, new construction, it drives GDP activities. Again, like I said at lunch, one of the biggest myths of China is people are commonly misled by GDP, and people tend to correlate the GDP performance and distributable earnings to minority shareholders, which is you and I. GDP is a measure of economic activities, the size of it. It's not a measure of distributable earnings, let alone distributable earnings to minority shareholders, which are mostly American and foreign investors in China. So when you see the economy boom and the company business grow, you have to make an assessment where the growth is from. Is it from sort of heavy spending? Is it from some related party transactions? And how does that translate into the profits that are possibly flow to the bottom line, eventually flow to you? So the real estate, I mean, it has experienced a pretty tough patch last year, but this year has been gradually recovering. A lot of people become, once again, hopeful that the sector will help the economy to recover. But our assessment is that I think the recovery this year in 2015 is largely driven by multiple government stimulus. And we are seeing a diminishing return on the stimulus. And more importantly, I think a lot of stimuli are pulling forward the demand, but did not create new demand. So what I'm saying is, it pulled forward the transactions, but once that's exhausted, perhaps sometime next year we're going to see a slump in the correction again in the housing sector. The problem here is a mismatch of the products type. There's large supply of unaffordable luxury large homes, and there's a large demand for affordable social housing like homes. So, and also China is like US, it's unevenly distributed. T1 cities is significantly different from T2, T3, and T2, T3 are significantly different from even lower tier cities in that the income level, the population, the economic advancement, population inflow, outflow are very drastically different. So what we are seeing is while T1 cities, 4 cities, major cities in China are holding very well, slight price appreciation this year. T2 cities are recovering, T3, T4 cities are seeing rising inventory. Most of the inventory data out there are measured by inventory weeks, so that's the absolute amount of inventory divided by sales per week. So even that's stabilizing and the sales volume goes up, that tells you the absolute amount of inventory is actually rising as well. So that's not a good sign, especially in lower tier cities. The second sector that we cover significantly and spend lots of time on, and actually our bestseller is the auto sector. That's global auto. We were the first research firm to make the call that Tesla will crash in China last year around Q3, and in fact it did in Q3, Q4 period. The company-specific problem with Tesla is pretty straightforward. The message conveyed in the product is not well aligned with the intention purchase by the Chinese consumers. People buy it as a status of symbol and as a very cool techie status, versus people here buy Tesla, and I mean a large part of it is for the environmental reasons of green technology. So once that low-hanging fruit is gone in China, the demand is actually very small. So we don't think China will continue to be Tesla's main market going forward. We were also the first shop to call BMW's significant contraction in China as a sort of a mid to high-end vehicle because of austerity measures by the government, because of weakening macro. We work with government bureaus, Public Security Bureau, to get to process the plate registration number, because we think the dealership, retail, published the retail data are significantly inflated because in a crunch time, dealers are likely to inflate their sales number to get better rebates from the OEM. So plate data is something that when you bring a car to the police department, they take pictures, they register your car, and eventually it's in the system, so that's very hard to manipulate. And we also work with the custom. So every time we have car import to China, we have the record. So based on that, we made a very timely call on TTM, Tata Motors, which is the parent of JLR, Jaguar Land Rover. So that brand, because of its pricing point, has been doing poorly, contracting a lot in China. So those are sort of unexpected to a degree, or larger than expected consequence of government austerity and the derivative effects. Same thing with Audi, same thing with BMW, less so with Mercedes-Benz because it's their big new model year. So the new product promotion offsets some of the weakness that we just discussed broadly. Macau casinos is our third sector. We work with people who work on the mass floor to get a sense of the sort of mid-range consumers' travel as well as their spending. We also work with the private VIP operators to get a sense of bigger spenders, their behavior, and whether they're increasing their trips or defaulting on their debt. So, I mean, we've been following that for 12 months, and we had a pretty, bearish view on them as well, on the thesis of the same thing as auto, the government anti-corruption campaign and weakening macro. Visitation, it's not going down on the hotel booking level because people still go, but the pocket depths changed significantly. Each person spend much less. In other words, the quality of visitors declined. So there are 6 publicly traded Macau casino companies in Hong Kong. We treat them as a basket of shorts. The fourth sector are e-commerce. So we don't follow Alibaba, which is the largest e-commerce company, for a simple reason that we think it's too well followed. Pretty much everyone covers it, everyone tracks it. We can't identify a significant edge on the name, but we track comparables, smaller names such as VIPS. They do flash sales. So it's an e-commerce of similar category of products, but just smaller. And we track a lot of business models that has a US comps. The true car in China is something called Auto Home and the Bit Auto. So the failure of true car raised our doubts of how such transition from an online media company to an offline commission transaction-based model will succeed eventually in a more commercially competitive environment. And our tentative conclusion is it's unlikely to succeed, and it has a lot of challenges in the near future, and they will keep on burning cash and build out the model, but the outlook is not very optimistic. The online Redfin, is it called Redfin? The online real estate e-commerce platform in the US, it has a Chinese comparable. A few of them actually, Soufang, Lezhi, and a lot of US investors actually like them because they think those names are a great play on the cyclical recovery of the housing market, and the valuation is really cheap. For the first reason, we think the recovery is going to be very short-lived because of the demographics and the house formation rigid demand is more likely on a structural decline as opposed to a secular decline. And valuation alone in itself never makes a good call on stock. That it's cheap, but we think it can go cheaper, much cheaper. So, and the last category is event-driven. So we putting everything that's sort of a special situation with a near-term catalyst. When we say near-term, because our clients are primarily hedge funds, we define like a 3 to 6 months as sort of near-term. With a significant near-term catalyst coming up, we've done enormous amount of work on young brands, which we think is to date probably one of the biggest disconnected names in the large cap space. It's a name U.S. investors love because they think it's a way to invest in China, middle class, rising middle class, the shifting consumer behavior. So China's repeating what U.S. had gone through in 60s or 70s, and rising income, people is going to eat more fried chicken. We think it's a simplified version. And if you look at the operating track record over the past 3 years, KFC has failed pretty miserably. Consistently, they overbuild. Even today, they're building one KFC store in China every 2 days. So that's a very aggressive expansion. And today is 2015. It's not yet at the 2012 sales revenue. But for some reason, it's a stock that has a lot of loyal followers, including Ken Gong, the founder of Home Depot. He is one of the largest investors in that company. And the argument is always, they have some misexecution this time, next time will be, and this time is different. It will recover faster. And even China fails, KFC will always sell in Africa. And maybe, beyond Africa, there will be some other emerging markets. So it's a conceptually very compelling story, but if you dive in, we send people outside of KFC stores, tracking at a fixed time, lunch and dinner, counting the people going, observing, because we couldn't go into the store, so we wait outside of the window, observing the type of food they put on the tray. And a lot of people just go there and get a Diet Coke or a Coke or something soft drink and just hang out there. It's a nice environment to hang out. It's actually nicer than those stores in the U.S. because they're newer and brighter. But they don't really do much. So I think this year, it's a recovery year, but we don't see any new customer going. So we survey them every day. We pick up. We choose about 10, 20 cities in China, depends on clients' request. And every day we pick 2 locations in each city, one in business district, one in residential district. And we time outside and observe the traffic, interview the neighboring competition, other fried chicken, fast food chain operators, and see what's the change in a trend, etc. So for those stuff we call event driven. We saw very hard on how to capture the volatility in Asia market, and we've done sort of the index comparison, and we certainly found that on a relative scale, Asia is still overvalued compared to the developed markets, sort of compared to its historical multiples. The forward-looking multiples, PE book multiples, is still very generously valued. A large reason for that is just like all the capital markets and stock markets in the world, it's liquidity driven. So Chinese government has been very expansionary for the past period of time, for the past long enough period of time, just like Japan, just like US. So, but the multiple expansion has come to the fore, the majority part of the index appreciation. So we think the Asia market will continue to come down, but how to play this? Since Asia market, if you want to short the index, it's very hard until you're a large investor and you have brokers do some sort of synthesizing, some products for you. So we happened to find a stock, Chinese company, but listed in the U.S. It's a wealth management company that rode the upcycle of the housing sector and issued a lot of real estate-backed trust products and wealth management products with high yield. And when real estate took a hit, went bust, sort of a small bust last year, it started to try to identify the new investment target. And luckily, last quarter last year, it found the Asia market. So the company did very well Q4, and Q1 it kind of a little went ahead of itself and started to level up. So when on June 12th, so when the stock market busts, the management sort of looked at each other and they realized they made too optimistic sort of projection for the rest of the year. They thought Asia market, bull market is going to be sustained for a very long time. So, they sort of overpromised a little bit. So we use that to kind of to use that as a hedge of the downward volatility in Asia market. On that note, I also want to talk a little bit about privatization. So I mentioned when I was at a hedge fund as a hedge fund analyst around 2007, I saw a large amount of Chinese company came to US to get listed. One of the main reasons is, it's a more open market, so you don't have to have, track record of operating income, you don't have to have earnings, and NASDAQ is full of companies that don't have earnings. So, it's very welcoming and accommodating. But now, a lot of those companies sort of passed their growth peak and trade at not so attractive multiple in their own view. Maybe those multiples are still very generous. If you analyze them objectively, but to management, they feel like they've been discounted by the U.S. investors. So there's a new wave of going private. So private equity funds are the equity participants, and they raise equities and the bank loans and come to the U.S. and buy out all the shares floating in the U.S. and privatize those companies with a very definitive goal of getting relisted in Asia market. So it's like a financial engineering, arbitraging the valuation difference between U.S. market and Asia market. But here's a big assumption. The assumption is Asia market at that time when they proposed those deals, they assumed the Asia market will continue the bull, the upcycle, till they get a deal done, and usually it takes a few years to get the deal done. So right now it looks like Asia is not going to be so strong as they expected. There's no sort of clear sign how those deals are going to end. But one thing that's pretty clear is as the Asia comes down, the relisting price will drop. So the equity sponsors needs to adjust their cost of deal accordingly for them to arbitrage a profit. Otherwise, they will sit on a loss, and they're certainly not going to do those deals. So they will cancel the deals. So for one deal that's already announced, the Qihoo, which is sort of like, which is Baidu's competition, also in the search space. They announced that they got a tentative, non-binding privatization deal. I don't remember the price target. I assume it's $77 or something dollars, but they recently revised down by roughly $9 or $10. That's hinged upon, that's a result of declining performance on Asia. So, it's very interesting to see, so many activities, whether it's business or the market activities are, in itself, it's not really creating that much value, but sort of, kind of by manipulating and kind of, playing with the capital markets somehow keep people make personal gain. I think the final word, tomorrow it's going to be the Fed announcement on, whether the meeting on whether they raise the rate or not. A lot of clients ask about the impact on Chinese economy, Chinese market. The simple answer is it's just not material. It's not material. The impact will be not material to the market, not material to the economy. So I want to leave enough time for Q&A. Yeah.
So you were talking about Macau and gambling, and I know that there's always supply demand, and but what I don't have a good understanding of, and maybe you could help, is the government has a position, and they were supportive of that whole industry, and then they kind of pulled back support. If you are a typical VIP customer, or if you're a non-VIP customer, what impact does what they think the government wants you to do have on
So the question is how government's position, attitude towards Macau impact gamblers. I'm not sure government actually cares about gamblers. I mean, Macau is Macau for, I think, for a major reason that it's a money laundering destination. And once that's tightened, it loses its appeal. I frankly don't even think government in Beijing, the central government, cares about Macau revenue. Macau government cares about it, but it's rather, vulnerable to the Beijing decision. So that's number one. Number two, the VIP gamblers, they are largely, people, they are private business owners taking government affiliates out for, a trip or whatever. So that's on a decline because of anti-corruption, because of the tightening of the use of the union pay, which is commonly used vehicle.
So it's not morals, it's corruption.
Easy credit absolutely facilitated the borrowing, but credit is no longer easy because the VIP sponsors or operators realize the debt has gone bad. So they have to come, originally I would imagine they went after the borrower, but since gambling is illegal, so once the borrower is back in mainland, there's nothing they can do. So what they can do is a lot of people did was last year, they actually transferred the borrowing to like a third party collector. So the third party went after the guy, like say, I don't know, just, sell me your jewelry, sell me your car, the housing, whatever, watch, whatever. So I'll collect 80 cents on a dollar, make money that way. But today, I don't know. That's a good question. I don't know how much they collect, 60 cents on a dollar. Likely to the bad debt, right? Yeah.
Talk a little bit more about the anti-corruption mood. That's been going on now, by my recollection, not quite a year, 2 years. I think it started January 2 years ago, so it's been in place for a long time. How much longer do you think that overall attitude and position is going to be, and what happens, or how do you figure out that it's ended, and who would be positive plays, presuming it does?
So the question is the status of anti-corruption, and where are we in the cycle? I think it's going to be ongoing for a long time. At least we are not seeing it's getting weaker. If anything, it's picking up the steam. You read today's newspaper or Bloomberg or whatever, you see they're investigating the heads of major security firms, CITIC. So, every day there's new news, and it's getting more and more entrenched to, the banks and the brokerage firms and the financial institutions. So we actually, we take a group of investors to China to meet with the policymakers and policy advisors twice a year. Last year, I remember we actually met with the U.S. embassy there to exchange notes. They are basically on the ground CIA people, right? So their job is to collect the local intelligence. So they're pretty in charge with governments and the sort of the officers. It's the new norm. I think the mainstream media got it right. It's the new norm. That's the way how they do business today. And I don't see any changing coming soon. And other than, in addition to all the effects that I just talked about, the tightening of government-led consumptions and the conspicuous spending, the other part is a lot of local government-led activities, whether it's building infrastructure or getting projects approved, those are kind of delayed. People wanted to wait out. People don't want, like I said at lunch, people don't want to proactively, be seen as aggressive out of the liner. So that certainly compromises some of the growth as well. So to your answer, mid-cycle, I guess, it's been 3 years.
Yeah. On the anti-corruption do you think the anti-corruption initiative is going to long-term reduce corruption in China? Do you think it's going to be effective at doing what it's supposed to be doing? Do you think it's going to give China a long-term structurally brighter future result of the initiative, or do you think this is not going to work out the way the people intended to?
So I guess the question is anti-corruption going to have a positive longer-term result or implication? I mean, I think that ultimately you're asking a question whether it's possible to have a one-party system, the lack of democracy, but meanwhile to have a clean society.
Right, exactly. To what extent do you expect to be
I mean, I mean, what's the historical precedent? None. So I guess I answered your question.
I like that answer. That's kind of what I thought, but I didn't know.
Mm-hmm. I think corruption is a result of authoritarian, coupled with lack of media freedom, media independence. And in China, every major outlet that writes on the elite families and their financing, such as Bloomberg did, and New York Times did on Wen Jiabao's family finance, got kicked out. Their visas immediately for the employees immediately got revoked, and they are no longer invited, or they are no longer allowed to report real time in China. So everyone works cover China for Bloomberg, and now everyone is in Hong Kong. So yeah. So I mean, I think it's very interesting to see how economically advanced, or at least from a reported. Headline economic data. I mean, regardless whether 7% is still very attractive if it's real. You see a very much backward in sort of a press freedom, in sort of definitely in terms of like how you can access like Bloomberg, CNN. CNN is not allowed in public places in most of the hotels. You can watch CNN in your room, but. And sort of a societal freedom. I think it has been a backward for a while.
Right here.
Yeah.
Let me ask you a question. I've never been a favor or a believer in communist government economic statistics. So how true do you think growth rates currently are?
Mm.
If the statistics are real, how they will affect the yuan valuation, and whether or not they will affect the inclusion of the yuan in the SPR at some point.
So the question is, what's my guesstimate of the real GDP?
Do you believe?
Or do I believe?
Do you believe them? Because I think they're false.
Okay.
Okay?
Mhm.
So do you believe them? I mean, I'm sitting on the outside remembering Russia from the 80s. I mean, they were bigger than the U.S., but they weren't.
Mhm.
So I don't necessarily agree with everything they've said. Okay?
Mhm.
So if their statistics are false,
Mhm.
the yuan is too appreciated, it's got to be devalued more, and how does that affect the overall thought of them eventually being included in the SPR?
So the question is whether GDP is false or not, and the impact of devaluation on the economy and the SDR inclusion. No, I don't think the current 7% real GDP is reliable. I don't think it has ever been reliable, so that's no new news. So 7% implies 5% nominal and 2% deflation. And I think a lot of economists, sort of with independent minds, look at the Li Keqiang index, which is a combination of rail, freight, electricity usage, and something like a cargo or something activities. I think the general view is it's more likely to be from like a 3 to 4%. But again, I mean, this combination of indexing underweights the services, which is supposed to be growing faster and hopefully to offset the weakness of a fixed asset investment manufacturing index. So to your question, I don't think it's reliable. Historically, it's never reliable. It's a result of the poor data collection, processing, the models they use, the regressions they run, and the speed that they need to get everything done and announce the data is the fastest in the world. So, and also, the intentional sort of ground level manipulation, fabrication of the data so that they, stay safe politically, from corporates to local governments to county governments and to the central government. Renminbi devaluation in August, I think it's, I don't know exactly the reason why they did it at that time. It was unexpected, the market didn't like it. But I think it's partially in response to the IMF study in the spring, which claimed that they think renminbi was no longer overvalued. And my understanding is, because I went to see the state council in April, and they were saying the government is determined to carry on reform, which is to de-emphasize manufacturing and export. So my sense is they kind of did something completely opposite of what they said a few months ago, probably is a result that they felt that domestic demand is weaker than expected. So they had to do something to stimulate external demand to make the headline number. So that's a part of the reason too. However, the magnitude of depreciation, which is currently under 4%, is not going to help with the volume of export.
And I'm going to see if you can expand on that. You said 7% growth, 5% nominal, 2% deflation. They're going to devalue, and it looks like they want to devalue more. So they're going to try to export all this deflation out here, right? I'm still trying to figure out how they're going to do that, all right? And still expect to be included in the international currency regime, the SPR, which looks to be their long-term goal. To get a reserve status of some degree, whether it's like a British sterling or a euro or even a worst case an Aussie dollar.
Yeah.
I just don't see if they're going to keep doing that. They're kind of undercutting their own strategy.
I think SDR, so the question is the implication of devaluation, the further devaluation on SDR. I think they compromise its chance for sure, but I think the SDR inclusion is more political, sort of the face kind of a decorative purpose. It doesn't have any practical issue. I mean, it's a reserve currency, so once you are included, you feel like you achieved a certain international status, but in reality, it doesn't have any practical, meaning. So, so that's fine. But by no measure, I mean, I've spoken with a lot of my clients. I mean, no one with a brain thinks that it's anywhere close to the requirement to be included by any stretch. Hi.
Hello. I was wondering if there were any opportunities that you could see on the quality of life front. I mean, we've talked about or heard about the pollution issues, some problems with expats leaving some Chinese cities because of the pollution or the quality of life. So, as an analyst, do you see any opportunities in that particular sector? It's one that you really didn't mention, and I thought that might be kind of interesting. Or maybe it's because the government is too involved. I have no idea.
I mean, I think that relates to healthcare consumption, not a capex. But research and the drugs that targeted at a certain disease related to air pollutions, I mean, potentially, I don't know, I haven't really looked in depth. I would imagine some cancer, specific cancers or sort of a chronic disease, especially the child care. Because even with the relaxation of one-child policy, it's become so unaffordable to have a second child. So a lot of families still continue to have just one child. So they're very willing to spend on that just one person, whether it's education, healthcare, anything related to mother and baby care. That would work. Certain technologies like indoor purification of air. Every time you see sort of the index, the air pollution index went up, there's an immediate shortage of air purifier or filtration something. I mean, this is a very serious issue. I mean, my sister lives in Australia, and I think the fact, and she lives in Australia with my niece of 4 years old. When actually the husband, my brother-in-law, actually works in Shanghai. And it's a very inconvenient and not so great arrangement, but it's good for the child to go to a more sort of open-minded schools, and also it's an escape from the pollution. So it's very real, and yeah, I mean I know lots of companies needed to double their package to keep the expats there. Yeah. Hi.
Can you just talk a little bit about unrest in China and whether there is a possibility of that causing, if the economic does downturn, will unrest be another issue to deal with?
Yeah. So the question is social unrest. I think there are like a sporadic reports on sort of people losing money on the stock market. On their, like at one point of time wealth management product. So one branch got closed because there's a bank run, people line up, but nothing significant enough. Because if you think about this, real estate, which is the one of the main investment channel in China, regardless of the correction in 2013, in some cities the discount, the stock, the price, the home price actually came down as much as like 50%. But in majority of the place, especially heavily populated cities, like the large cities, it's still appreciated very much. Chinese wealth is real estate wealth. And how it goes, I don't know. But right now, the bubble hasn't busted yet. So, I mean, it's a really hard call in terms of timing. It's just like, in 2007, 2008, actually a lot of money managers foresaw the coming of financial crisis, but very few people timed it, and even fewer people predicted the magnitude of it. A lot of people actually started to use hedge, like say for example, shorting like a consumer electronics to hedging the declining of disposable income, a weak economy, but no one thought that it's a trigger for like a multi-year long Great Recession. So, I mean, I think it's the same thing. I mean, I think housing there remains very unaffordable, and there's a significant glut of inventories in cities where population net outflows. But
one of the things I've heard from other Chinese nationals is that they don't believe in the government. They don't believe in the government currency, so they're big believers in gold. And that a lot of the people own gold because they've seen the overthrow of government. And they've seen some of them. I'm not sure whether gold or diamonds are better. Well, I think it depends on the lady. But.
Yeah, I think so, because gold, I mean, industrial use, I mean, I don't know. I mean, just common sense tells me gold is like another currency. It's built on confidence. So once the confidence is gone, what's the practical or industrial medical use of gold? It's less than the diamond. So, I mean, I would think if you want to kind of, as a hedge of run on confidence, probably other stuff are better. But I really don't really know too much about it. Yeah.
You talked about A shares, ADRs, but the other way to invest is through H shares. Obviously, that's been ongoing for a long time. And the H shares did not get the benefit of the A shares increase, but have taken the toll. Do you have any thoughts?
H share is more like made of state-owned, the large state-owns. A lot of them are like developers. So it's kind of like a sectors in a secular decline. And Hong Kong, the perception is, it's no longer special because, I mean, it's a part of China. So, and before the city was special because, it's a, economic special zone. But now Shanghai kind of replaced the Hong Kong in that kind of status. So I haven't done much work on. I mean, the investor base is slightly different. It's more institutional driven. So I mean, it's kind of in between ADR and A share. But on a relative valuation, yeah, I looked at the charts and I looked at the valuation. It's definitely much cheaper. But the earnings growth of H share companies, the companies in portfolio has been very slower than A share as well, at least from the reported or self-reported data.
And do you have any other insight on MSCI, including A shares, and ADRs are going to go in the MSCI indices, but also A shares?
No, I don't. I'm not sure. Personally, so the question is about CI inclusion of A-share, whether that's going to give A-share a boost?
Or the inclusion of it, because they were close to including them, but
Uh-huh.
said they needed more time to do more studies on it, and obviously that was very timely to postpone it.
No, I haven't done any specific in-depth work on this, but I think that you might want to look if A-shares are already included in other index. So the reason for inclusion and possible effect on A-share is because of the inclusion. So a lot of people will become the owner of A-share through the ETF or index. But if you look at it, if you find out A-shares already included in other index, then it shouldn't budge too much because of that specific index inclusion. Yeah.
The stated policy of the government is to shift from a manufacturing base to a service base. The U.S. Wage rates for services are substantially lower than the wage rates for manufacturing. Wouldn't that same kind of shift, and I've got no data, but wouldn't that same kind of shift in China cause, personal income and to decline as the government, drives jobs toward lower paying jobs, and therefore there'd be a lot slower growth coming down the pike?
So the question is whether the rising service sector is going to put pressure on wages and the drive jobs, manufacturing jobs out of China, right? I'm not sure where did you see the data service wage are actually lower than manufacturing, because that's sort of contradictory, right? I mean, service, that's a broad definition. I mean, education is service, healthcare is service, science is service. Anything that's not labor intensive is considered, not capex is service. So I'm not sure if I buy into that data. So I mean, yes, the government wants to downplay capex model and want to do more service, and they're in a process of restructuring. So the original China story is, so it's a reform-driven story. So once the reform is successful, it might or it might not, but you can bet either way you want to. But one thing that's inevitable is typically in the process of restructuring, economy slows down, because when the capex-driven economy drops 10%, for it to get even, the service needs to immediately pop up 10%. So unless you already have a service industry that deliver 10% growth, you cannot be in the process of finding or forming service industry in the process of manufacturing dropping 10%. That's the problem right now. And service-oriented economy requires a different set of labor force. They tend to be more innovative, independent thinking, and more creative. Not sure if the software, meaning human capital, is compatible yet with that goal, with that kind of setting. So, yeah.
Do we have one more question?
Along
very quickly, some big consumer companies, Remy, Lee Johnson, maybe Nestle,
Yeah.
had some hiccups. The story is that there's been a switch to online, which has helped private label. Does that strike you as accurate?
Haven't done any work on it. I always wanted to look at those, but just frankly, just because of the resources constraint, haven't done it. I know, yeah, Lee Johnson is very much a China-driven story. Yes.
T-shirt for your work. And, we're going to have all of these speakers be honorary members, so that if you're in town and you want to come back to a meeting, please feel free. If you'd like to join our group on LinkedIn and make comments or have any of your work, I think that people are interested. Her work is going to be on the website when we send out the survey. So a sample of her analysis on industrials will be available to all the people who came to the event. And I think that we'd like to keep the discussion going as China.
Yeah, just one more point. I mean, the work that's you guys gonna see on the website, those are actually very, very good. Not self-marketing here, but it's really so it actually went back all the way to end of June when the Asia market correction took place, and then a string of events took place in a very busy summer, and then we responded to each change of situation with a sort of a quick note. At that time was real time to our clients. So, and then that covered the A-share reaction, privatization, and then the valuation of cross H-share, A-share, ADR, and the devaluation impact on the on a global economy and the U.S. market specifically, but also talked a little bit about how each market sort of post the 2008 has been largely driven by the liquidity sort of scenario, but with a mix of results. So I mean, we actually did a lot of study for those reports to clients. So hopefully you guys will enjoy it.
Thank you.